Okay, this is the outline of my presentation today. So there are more than 10 topics I'll touch upon. Last but not least, I'll share with you our stock pick for the first quarter. Okay, the China and Hong Kong market fare quite disappointingly compared to the US market and other regional markets such as Japan. Japan is seeing new highs, the index compared to India and Taiwan. China and Hong Kong also far lag behind. The Shanghai Composite Index dropped another 3% year to date up to yesterday after falling 3.7% in 2023. So we notice that this downtrend is still intact for both China and Hong Kong market, despite entering the new year. Okay, the Sunshine Component Index dropped 13.5% last year. Much worse performance compared to the Shanghai Composite Index. And in 2024, so far, it dropped another 5.9% year to date. For the Hang Seng Index, last year, our Hang Seng Index dropped 13.8%. And year to date, up to yesterday, in fact, the Hang Seng Index dropped another 5%. But this chart is up to yesterday. So if you have followed the market today, the Hang Seng has dropped below 16,000 this morning, and also dropped below the trough, 15,972 points seen in December last year. So we saw a new low since October 2022. That was the lowest level. Today, the Hang Seng Index dropped to close to 15,900, the lowest since October 2022. Okay, and the Hang Seng Tech Index fell 8.8% last year, but entering 2024, it performed rather badly, dropped another 9.6% up to yesterday, since the beginning of the year. Okay. Okay. Reason for the performance is the Hong Kong and China markets are facing a lot of headwinds. There are still a lot of headwinds. For instance, geopolitical tensions. Now you have two wars going on in the world, the Ukraine-Russian war and the Israel-Hamas war. And US-China tension is intensifying given friction over Taiwan, the South Sea, and tech war. Okay, 2024 is also an election-packed year. It is calculated that countries with totaling 2 billion population are holding elections this year. So election results may, I emphasize the word may bring about turbulence to the stock market. Okay, and China's post-COVID economic recovery remains bumpy, and deflation fears are on the rise. So this headwind have been is impacting the stock market since the second quarter last year. So there's very little so far, very little improvement in any. We don't notice significant pickup in economic recovery so far in China. And Chinese developers' debt woes continue amid renewed home sales softness and also a lack of aggressive stimulus. Adding to the developers' debt woes, another debt crisis is also causing a concern to investors is China's provincial government's hidden debts. I'll go further into details later about the size of the provincial government's debt and return of regulatory uncertainty. One example lately is the guideline, the amended rules on online games that caused sell-off among Tencent, NetEase, and other games publishers. Okay, another negative factor, another headwind is exodus of international capital, outflow of foreign capital from China, as well as domestic capital outflow, or not only international capital, but also domestic capital as well. Okay, China's central government debt is only accounts for only 20% of the GDP, which is not huge. But total local government debts are estimated at nearing 38.75 trillion yuan, equivalent to 5.31 trillion US dollar. Okay, and in addition to that, the so-called LGFVs is more a concern because it could be a source of volatility in China's financial system over the medium term. LGFV stand for local government financing vehicles. So these are aside from the debt issued by local governments. These are local government financing vehicles, and they may also owe to other debtors a lot of money. There are two types of LGFV, quintessential and hybrid. Although both are local government owned entities, the hybrid LGFV have more diversified holdings and behave like state owned enterprises. For example, a hybrid LGFV may finance public housing as a local government would do, but it can also invest in commercial property, just as a private company can. So the scope they operate is wider, and the control or is less transparent compared to the former, the quintessential LGFV. The risk of LGFV default is concentrated in these hybrid LGFVs. And since the debt, some of the debts are hidden debts, so the actual amount is not disclosed. The actual amount owed by these provincial governments hybrid LGFVs. Okay, and LGFV's debt repayment issues relate to a sharp drop in land sale revenues because a lot of provincial government rely on land sale revenues to sustain their expenses. Okay, and also caps on the ability to tap alternative sources of funding. The inability to raise new money also restrain them from paying their debts. So LGFV's debt repayment issues relate to a sharp drop in land sale revenues seen in the last 2 years in the downturn of the property market. Okay, I quoted here one example of regulatory uncertainty. The National Press and Publication Administration of China, NPPA, recently published a guideline titled Measures for the Administration of Online Games. This was published last December 2023, representing the largest regulatory changes since additional restrictions were imposed on Chinese youth gamers in September 2021. And when this was announced, it caused a sharp sell-off among online games operators, publishers such as Tencent, NetEase, and other games publishers. The draft states that online games should not include reward mechanics that encourage users to overspend, such as providing users with additional in-game rewards by logging in each day. Currently, for users who log in every day, they are given additional in-game rewards. So this will be banned in future if the draft becomes law. Okay, and also purchasing an in-game item for the first time, users will be given some reward. This will not be allowed in future. Or purchasing an in-game item or service on a regular basis. These activities will also be banned. Game publishers should not provide or condone the behavior of trading virtual in-game items through speculative auctions. I read from the report some of the in-game items, the so-called weapons, 武器, the very unique one, rare one, could be traded for up to millions of millions renminbi in the secondary market of virtual in-game items secondary market. So going forward, game publishers should not provide or condone this kind of behavior. And publishers will also be required to warn users with a pop-up if they start to spend too much and set a cap on in-game spending, which is outlined in the terms of service. So all in all, the draft would impact what is the largest potential impact will come from a spending cap on users, especially those games especially those high ARPU games. That means the average revenue per user is a high one. But high DAU, daily active users, and low ARPU games will be less impacted by the new draft. Okay, the high ARPU games will be affected more. So this will affect the profitability of companies like Tencent and NetEase. Okay, regarding exodus of international capital, according to China's State Administration of Foreign Exchange, the net capital outflow reached 53.9 billion US dollar in September last year, the largest amount since January 2016. 2016, when China logged the net in outflow of 55.8 billion, triggered by a sudden devaluation of the yuan called the renminbi shock in 2016. But last September, the renminbi, although it's still weakening, we did not see a sharp devaluation. So it was not really caused by the devaluation, the yuan devaluation this time round. It's caused by other factors, namely foreign companies are scaling back their operations in China and repatriating funds back to their home country. And also wealthy Chinese are shifting funds abroad. I think Singapore benefits from this fund outflow from China. Wealthy Chinese are either moving their assets to Singapore or setting up family offices in Singapore. Besides, the US has moved to restrict American investment in mainland China, and Beijing's revision of its anti-espionage law in July last year, which expanded the scope of targets for espionage, may also have contributed to this capital outflow, fleeing the country. To stanch the flow, the China Securities Regulatory Commission has issued a notice banning domestic brokerages from taking on new mainland clients for offshore trading. It also intends to impose restrictions on new overseas investments by existing customers on the mainland. Brokerage houses, including their overseas divisions, are ordered to shut down apps and websites aimed at mainland investors. So this has a negative impact on the Hong Kong market as the cramp down on mainland clients trading. They are still able to trade Hong Kong stocks via the Stock Connect. But for it is believed that in the past, a lot of mainland funds are investing directly into the Hong Kong market, not via the Stock Connect. Actually, they remit the money to Hong Kong and then invest either in the property market or the stock market or in other overseas market via Hong Kong. So with this being uh, uh, banned, it also has a negative impact on the Hong Kong stock market. Okay, uh, although the stock market do have some tailwinds, but not many. First of all, U.S. rate hike cycle is nearing an end. The market is expecting rate cut by the Fed, U.S. Federal Reserve this year, as early as March, if not March, maybe May or June. And then U.S. recession appears less likely. There were fears that the U.S. Economy may be heading for a hard landing recession, but so far economic data shows that recession now becomes less likely for the U.S. And the Chinese yuan also seems to be stabilizing. Now is has strengthened to 7.1, around 7.1 to $1. The weakest level, depreciated to between 7.3 and 7.4 to $1. Now it has strengthened to around 7.1. And then with yuan strengthening, the PBOC, People Banks of China, will have more room for more RRR, stands for Reserve Requirement Ratio, RRR cut, as well as interest rate cut. Actually, entering 2024, the market was expecting a cut in the in the MLF medium loan facility interest rate yesterday. But the PBOC disappointed the market with no move yesterday. The MLF interest rate remained unchanged when they conducted MLF operations yesterday. Okay, but there's still hope that the PBOC will cut RRR and interest rate again in the first quarter. Okay, and the China's Politburo meeting held late last year did raise expectations for more economic stimulus. I'll go into more details later about the takeaway from the Politburo meeting held late last year. Okay, how Fed pivot? Pivot stands for a change, a turnaround in the rate hike cycle by the Fed. Now, the market is expecting the Fed to start cutting interest rate this year. How Fed pivot affects the stock market? Actually, we observed that when the Fed interest rate went up, say for instance, in when the Fed interest rate rose from 3% in September 1992 to 6.5% in May 2000, the stock market also rose in tandem. Uh, uh, and when the Fed started to cut interest rate from 6.5% in May 2000 to 1% in June 2003, after the dot-com bubble burst, the internet, the dot-com bubble burst in year 2000, the stock market actually fell when the Fed cut interest rate. And then starting from June 2003, the Fed raised interest rates again, this time from 1% to 5.25% in June 2006. And during this period, the S&P 500 also rose. Okay. Then in June 2006, the Fed cut interest rate again from 5.25% to 0.25% in December 2008. And this time round, the stock market, the stock market also dropped. You can see here, the arrow points to here. The stock S&P 500 dropped when the Fed cut interest rate. Okay. So last year, you remember the Fed raised interest rate 11 times in a row, and the U.S. stock market rose to new record high despite the rate cut. Okay. So this is the same chart that I showed you. Okay, why is it so? General belief is that when the central bank raise interest rate, the stock market will fall normally. But how come there's an opposite kind of direction? Because it is believed that when the interest rate rises, the economy is getting overheated, is growing in a faster pace, so that benefits the stock market. Okay, when the interest rate holds on a relatively low rate, the stock market will also rises. But on the contrary, when the Fed cut interest rate, that means the economic growth starts to decelerate, starts to slow down, and the market always runs ahead of the economy. So when investors expect a slowdown, they sell their stock holding and cause the stock market to fall. Okay, but we noticed last year the Hang Seng index more or less follows the first and second phenomena on the U.S. market. However, since 2019, a decoupling has occurred. That means when the U.S. market went up since 2019, the Hang Seng Index had actually fallen 4 years in a row. It was the first time in the history of the Hang Seng Index that the index fell 4 years in a row. It has never happened before. So the reason for that is, as I have explained earlier, due to a lot of headwinds the Hong Kong market was facing in the last 4 years since the outbreak of the COVID-19 pandemic, and then the subsequent economic recovery that disappoints investors. Okay. Um, in the past, the Hang Seng Index more or less follows the US. It's because the Hong Kong dollar is pegged to the US dollar, which means US monetary policies also affect Hong Kong in many ways, such as home purchasing and corporate financing costs. So when the Fed raise interest rates, Hong Kong, our MA, our monetary authority, we have to follow suit because the Hong Kong dollar is pegged to the US dollar. In order to maintain the stability of the Hong Kong dollar, we have to follow US monetary policies. Okay. The decoupling occurs because the Chinese economy is on a downtrend since 2019, and companies from mainland China now accounted for 77% of Hong Kong EX market capitalization. Okay. Um, Now we are talking about this Fed pivot that the Federal Reserve is expected to cut interest rates starting entering 2024. So in December 2023, the recently announced data, US CPI, the growth rate decelerated, year-on-year growth rate decelerated to 3.4%. And in the last three FOMC meeting, the U.S. Federal Reserve kept rates unchanged and signaled rate cuts for 2024. And soft landing is within reach as inflation slows faster than expected and the labor market remains largely intact, stocking optimism that rate cuts will get underway as early as March 2024. Okay, if the U.S. Federal Reserve starts to cut interest rate, it will have a positive bearing on China and Hong Kong stock market in the following ways. First, UST bond yield is used by analysts as the risk-free rate of return when valuing the market or an individual stock. So when risk-free rate of return falls, it will bring down fixed income investment return, such as term deposit rates and bond yield, making them less attractive. So funds looking for better return may likely flow into the stock market. Among global stock markets, the Hang Seng Index estimated price to earnings ratio, the forward PE, is less than 8 times, substantially lower than its historical average. Its historical average is around 10 times, and the record low is about 6.7 times. So now it's only less than 2 times above its record low. The valuation of the Hang Seng Index is quite cheap at the moment. And under discounted cash flow DCF valuation method, when the discount rate, which stands for the risk-free rate of return, falls, company valuation will rise. Thirdly, entering the interest rate cycle, the US dollar will become less attractive, and non-US currencies such as the renminbi, the yuan, are expected to strengthen and rebound, which may result in an upward revaluation of renminbi denominated assets, including stocks. I mentioned earlier that now mainland companies account for 77% of the Hong Kong stock market in terms of market capitalization. So strengthening renminbi may lend support to the stock market. As US-China interest rate spread narrows, the PBOC will have more room to cut interest rates, which will lend support to the economy. Okay, so overall, generally speaking, the expected US Fed pivot, the rate cut cycle will have a positive impact on China and Hong Kong, especially Hong Kong. Okay, the US going to hold its presidential election later this year. So how presidential election affects the stock market? Our statistics show that in the past 18 presidential elections, only 4 times have seen a decrease, and 2 of them are due to financial crisis. The dot-com bubble that occurred in year 2000, and also the subprime mortgage crisis. So by majority, the stock market will tend to rise in the year of the US presidential election. Okay, if recession occurs, so how will it affect the stock market? Although the U.S. economy is doing well, with GDP growing at an annualized rate of 4.9% in the third quarter of 2023, the current inverted yield curve may still be signaling a recession. In the past, this inverted yield curve was quite accurate in predicting a recession. So there's still chance that, although not very high chance, there's still a possibility that the U.S. economy may be entering a recession. And if that really happens, based on historical statistics, during the first 6 months in the recession, the S&P 500 average performance would decline about 18%, and the average 12 months forward PE would drop to around about 13 times. Currently, it is more than 21 times. So the US stock is quite pricey at the moment. But if there's no recession, and if the US, the Fed will start cutting interest rate this year, so we don't expect a very deep correction. We do expect correction in the US market after the rally in late 2023. Actually, already saw that in early January. Yet, if there's no severe recession, we don't expect a deep correction we don't expect correction more than 20% in the US market. Okay, Now, let's come to China's economic review. Let's look at the CPI and PPI, which signals deflation. Okay, China's CPI hits 3-year low in December, far below the 3% official annual target, fueling deflation fears. In addition, as a leading indicator, China's producer price index (PPI) also saw the 15th straight month of decline. You can see in this chart on the right-hand side, on the that PPI dropped 15 months in a row. So December was the 15th straight month of decline. Okay. Initially, deflation may positively impact consumers because it increases their purchasing power. However, an entrenched period, if it goes on for too long, an entrenched period of deflation may create a vicious cycle that starts with a slowdown in consumer spending, followed by business cutbacks and layoffs, leading to high unemployment, less spending, and more defaults. Okay, to fight the pernicious and devastating effects of deflation, central banks may need to use extreme measures and innovative tools to combat deflation in their economies. Okay. China's official manufacturing PMI also did not fare so well. You can see in the chart here, it shrank for last 3 months and also at a quicker pace, from 49.5 dropping to 49.4 in November last year and to 49 in December last year. And China's official non-manufacturing PMI, which includes services and construction, likely rebounded to 50.4 in December from 50.2 in November last year. Yet data showed the services sector contracted in the last 2 months. So construction holds up with the support of more infrastructure investment, but services PMI show contraction in the last 2 months. It means more stimulus will be needed to shore up economic growth and restore confidence. We're still expecting more economic stimulus. Okay. In terms of loan growth, in December last year, renminbi loans increased by 1.17 trillion yuan, which was lower than market expectations of 1.35 trillion yuan, and also a decrease of 240.1 billion yuan year on year. In 2023, renminbi loans increased by 22.75 trillion, an increase of 1.31 trillion. The increase was also lower than market expectations. However, the M1, M2 scissors gap narrow. You can see from the table on the right-hand side. In November last year, the scissors gap rose to as much as 9.1%. And now in December, it fell back to 8.4%. With the widening scissors gap, people will tend to leave their money with the bank, with bank deposits rather than spending the money, because deflation also changes the spending pattern, will affect the consumption pattern of consumers, because things are getting cheaper, so consumers will tend to procrastinate their consumption to a later stage, and this is negative to. This is not favorable to retail sales as well as consumption. Okay, as people prefer to save instead of spend or invest when the scissors gap widened. But on the contrary, when the scissors gap narrow, people will tend to spend more and also invest more. Okay. Um, Now let's look at the 三头马车 the troika, fixed asset investment, industrial output, and retail sales. In November, they have not released the December data yet. In November last year, the added value of industrial enterprises above designated size increased by 6.6% year on year, beating expectation of 5.7% growth, and the growth rate accelerated by 2 percentage points from October last year. However, the total retail sales of consumer goods increased by 10.1% year on year, much lower than the expected 12.5% growth. And although it's 2.5 percentage points faster than October, yet it's lower than market expectation. In addition, national fixed asset investment growth in the first 11 months last year was only 2.9%, a meager 2.9%, and remaining flat compared to the first 10 months, also lower than expected 3% growth. Reason behind is it was dragged down by real estate development investment, which fell 9.4% in the first 11 months last year, which is also worse than market expectations. Okay, 2024 economic outlook. Last year, fourth quarter, they have not announced their fourth quarter GDP data yet. We expect China's Q4 2023 GDP will grow by 5.3% year on year versus 4.9% in the third quarter. So for the whole year, GDP growth is seen at 5.2%, meeting the government's annual growth target of 5%, partly helped by the previous year's low base effect, which was marked by COVID-19 lockdowns, the low base effect in 2022. GDP growth this year is likely to slow to 4.6% from 5.2% last year. And it is expected to cool further to 4.5% in 2025. Okay. We also notice a slight pickup in exports seen in the last 2 months of 2023, but this is unlikely to kindle a quick turnaround in weak domestic activity. Okay, inflation this year is expected this may be a too optimistic projection, because we are expecting inflation of 1%, but now it's still negative. And in 2025, inflation may rise further to 1.6%. Commercial banks seen cutting benchmark lending rate by 10 basis points in first quarter. This is market projection that commercial banks will cut their benchmark lending rates by only 10 basis points in first quarter. Okay, what are the takeaways from China's Central Economic Conference? Okay, consumption is playing an increasingly important role in driving growth in China, with consumer spending contributing 83.2% to economic growth in the first 3 quarters. The tech-intensive green trio of solar batteries, lithium-ion batteries, and electric vehicles have replaced apparel, home appliances, and furniture to become the top drivers of China's foreign trade. And the total export value of these products jumped 41.7% year on year in the first 3 quarters of the year. This is also due to a rather low base in 2022. To further revive the economy, China still has to overcome some difficulties and challenges, including a lack of effective demand, overcapacity in some sector, lackluster social expectation, and certain risks and hidden problems as well. Okay. Overall, favorable conditions outweigh unfavorable factors in China's development, and the favorable and the fundamental trend of the economic recovery and long-term positive outlook has not changed. The meeting said the China Central Economic Work Conference stated that the fundamental trend of the economic recovery and the long-term positive outlook has not changed, urging stronger confidence from the people. Okay. Regarding this year, it should be this year. Regarding this year, because when the Central Economic Work Conference was held last year, so they stated regarding next year's economic work, the meeting called for efforts to pursue progress while ensuring stability, consolidate stability through progress, and establish the new before abolishing the old. Uh, so China has, unlike in 2008 and 2009, when China put aside 4 trillion, made 4 trillion yuan stimulus plan, stimulus package to support the economy. But this time round, the Chinese government is taking a very cautious and prudential attitude in launching stimulus package. So we don't expect the trillions kind of stimulus package seen in 2008 and 2009. Okay, the Central Economic Work Conference stressed that a prudent monetary policy should be flexible, appropriate, precise, and effective. And it called for guiding financial institutions to step up support for technological innovation, green transformation, and other fields, and maintaining the stability of the renminbi exchange rate at a reasonable and balanced level. It also stressed the need to effectively remove the obstacles for foreigners to come to to China for business, study, and tourism. Efforts must be made to actively and steadily resolve real estate risk and meet the reasonable financing needs of different real estate enterprises, aiming to promote the stable and healthy development of the real estate market. Okay, now come to the yuan renminbi's outlook. As the U.S. Fed is expected to start cutting interest rate in 2024, the U.S. dollar may weaken further. And actually, the U.S. Dollar index has retreated from around 104 to around 101, 102, and we expect the U.S. dollar to weaken further as the U.S. Fed is expected to start cutting interest rate this year. And the interest rate gap between China and the U.S. will gradually narrow, easing the downward pressure on yuan. We also notice a widening gap between China's fix. This fixing is the official renminbi exchange rate versus the US dollar. And it's for the last few months, it is considerably higher than the estimate. The fix is higher than estimate. Why is it so? It signals that the authority wants yuan's pace of decline to be as low as possible. So by estimate, the actual rate should fall to, say, for instance, 7.05. But the fix was it was fixed at 7.1. So the widening gap signals that the authority doesn't want to see yuan declining so fast. Okay, and the People's Bank of China stepped up yuan support recently after rating agency Moody's cut China's outlook to negative. Okay. According to the Central Financial Work Conference held in October 2023, more effort should be devoted to strengthening foreign exchange market management and maintaining the basic stability of the renminbi exchange rate at a reasonable and balanced level. The US dollar to renminbi rate is expected to, for this year, we expect the US dollar to renminbi rate to fluctuate between 7.05 and 7.3. If the yuan will depreciate again, we expect support around 7.3. If it appreciate, we also expect resistance for the yuan around 7.05 to $1. Also, it's not in the best interest of China to see the renminbi appreciate too much because it will affect its exports. Okay, so the yuan, this is offshore yuan exchange rate against the US dollar. It depreciated, it weakened to close to 7.4 to $1 between July and August last year. And since then, as the market expects the Fed to start cutting interest rate, and the US dollar start weakening, you see the yuan appreciating from from below 7.3 to above 7.1. Now it's 7.19. Okay. Our index target for first quarter. Okay, we expect the Shanghai Composite Index to fluctuate between 2,800 and 3,050, 2,800 and 3,050. Okay, the Shenzhen Composite Index, we expect the range. Here I have not included the range. The range to be between 8,700 and 9,000 9,200. Okay, so 500 points range expected. Okay, Hang Seng Index, we expect a range between 14,950 to 17,500. 500. Near-term support around 16,000. It has been breached today. This morning, the Hang Seng Index has dropped below 16,000, and the next support level will be 15,400. Key support will be 14,950, which was the low seen in October 2022 before the announcement of the opening up, the reopening of the economy after the COVID-19 lockdown. Whether will the index Hang Seng Index will fall to that level remains to be seen. But at the in the near term, it's very likely that it will test 15,400 when it fails to hold about 16,000. Near-term resistance is seen at 16,750. Next resistance is 17,100. And key resistance will be around 17,500. Okay. For the Hang Seng Tech Index, the near-term support is 3,310. Next support level is 3,240. Actually, recently has dropped below the 3,400 level, support level, and now is testing 3,300. If it drops below 3,300, next support level would be 3,240. Key support would be 3,000. Near-term resistance is expected around 3,540. Next resistance level 3,660, and key resistance is 3,800. Okay. In view of the market uncertainties of the many headwinds that we are still facing, we suggest investing in Hong Kong defensive companies such as utilities and telecom operators. For the reason that they are paying attractive dividend, current dividend yield between 5 to 7%, and the PB ratio valuation in terms of price to book ratio is relatively low due to substantial price drop amid the high interest rate environment. And among the 2,600 odd companies listed on the Hong Kong Stock Exchange, there are about 300 Hong Kong local companies. And among these, around 190 companies pay dividends. And of this 190, around 70 companies generate sustainable free cash flow, have reputable business operations, high quality management, and most importantly, have a long-term track record of paying out dividends. So we suggest investors to invest in Hong Kong defensive companies such as utilities and telecom operators. Okay, there are two stock picks. One, the power assets. The ticker is 00006 Hong Kong. The company is a global investor in energy and utility related business. It's a company owned by Li Ka-shing. Is one of the companies in the Li Ka-shing staples of companies. And it hosts Hong Kong Electric, which is the electricity supplier in Hong Kong. And for power assets, it has interest in the transmission of electricity, gas and oil, the distribution of electricity and gas, and the generation of energy from thermal, waste, and other renewable sources. The company was originated from Hong Kong over a century ago, so it's a 100-year-old company, 百年企业. The group also has a presence today in the United Kingdom, Australia, New Zealand, mainland China, etc., bringing clean, reliable, and affordable energy to about 19.5 million homes and businesses. And the bulk of its business derives from its interest in 520,100 kilometers of power, gas, and oil networks, supplemented by investments in around 9,800 megawatt of power generation facilities. Okay, financial performance for the 6 months ended 30 June 2023, that is the first half of 2023. Net profit attributable to shareholders amounted to 2.959 billion Hong Kong dollar, increasing 3.1% year over year. Earning per share amounted to 1.39 Hong Kong dollar, increasing also 3% year on year, and the current dividend yield is 6.2%. The current price to book ratio is 1.1 times, which is about -1 standard deviation, lower than its 5-year average of 1.19 times. Okay, power assets, the business outlook. UK Kingdom portfolio is UK Power Networks, UKPN, commenced a new 5-year price control period in April last year, and the company was awarded a 25% increase in actual expenditure compared with the previous period to invest in the electricity network to cater to the rollout of electric vehicles, heat pumps, and renewables energy generation. As you may be aware, inflation in the UK is also very severe. So for utility company, an inflationary environment is more favorable because it's easier for them to raise their fees as well as the awarded expenditure by the government. Okay, another company in its United Kingdom portfolio that is Northern Gas Networks, NGN. Its ongoing emphasis on customer satisfaction yielded high scores in surveys conducted by the regulator Ofgem. Uh, Wales and West Utilities, WWU, has met all its regulatory performance targets, so it's performing well up to it meet all the performance targets. And Seabank Power started a long-term full tolling agreement with a single customer, so which implies that the future income will remain stable with this long-term full tolling agreement with a single customer. Okay, with regard to its Hong Kong portfolio, as I mentioned, it owns Hong Kong Electric. Hong Kong Electric is discussing with the Hong Kong SAR government, which has commenced on the 2024 to 2028 development plan and the interim review of the current scheme of control agreement. Usually under the scheme of control agreement, the more the company invests in its fixed spend more fixed expenditure, the more tariff it is allowed to raise charge to its customer. So invest more, they will be allowed to raise the tariff. So we expect a tariff raise hike in the next development plan in the next 5 years period from 2024 to 2028. Okay, regarding its Australian portfolio, the group's electricity distribution businesses continue to migrate and augment network capabilities to accommodate large-scale solar generation. And one focus area is providing battery solid storage for solar power in Australia. Okay, you can see the share price outperformed the Hang Seng Index. Now it's trading around 45, 46 Hong Kong dollars, yet still yielding more than 6% dividend yield. So we do expect, and the price to book value is only 1.1 times, equivalent to -1 PB, price to -1 standard deviation. So we expect its share price to test the peak seen in May 2022, close to 50 Hong Kong dollars. So another 10% upside. Our target is 10% upside plus 6% dividend yield. Okay. The other stock pick, the company we picked is Hong Kong T Trust, Hong Kong Telecom. The stock code is 6823.HK. It is a technology, media, and telecommunication leader with more than 150 years of history in Hong Kong. So in the past, it was originated from the Hong Kong Telephone, from this company called Hong Kong Telephone. Now it has diversified into different business streams. Its end-to-end enterprise solutions make it a market-leading digital transformation partner of choice for business. Its businesses primarily consist of local TSS services, telecom services, local data services, pay TV services. It owns the Now TV in Hong Kong, local telephony services, and international telecommunication services. So for the 6 months ended 30 June 2023, total revenue excluding mobile product sales increased by 3% to 15.24 billion Hong Kong dollars, reflecting the delivery of digital transformation projects for enterprise and government customers, and also continued strong demand for its fiber services, and gradual recovery in roaming revenue and further momentum in 5G adoption in Hong Kong. Total revenue grew by 2% to 16.4 billion if mobile product sales are included. However, last year mobile product sales was rather soft last year as demand for new handphones there was not very strong demand for new handphones. Total EBITDA, earnings before interest, tax, depreciation, amortization increased by 3% to more than 6 billion Hong Kong dollar last year, in the first half last year, spurred by sustained cost efficiency initiatives across the group. Adjusted funds flow increased by 2.2% to 2.429 billion Hong Kong dollar. So very strong cash fund flow that enables it to pay dividends, pay decent dividend to its shareholders. Profit attributable to holders of its share staple units is a trust, is a share staple, increased by 2.2% to 1.952 billion Hong Kong dollars. And its current dividend yield is even higher than the power assets with 7.8% dividend yield. Okay, business outlook. Mobile business growth in services revenue will continue to accelerate as travel resumes with full border reopening between Hong Kong and China, creating upward momentum for local consumption and travel-related spending. We do see more tourists from mainland China coming to Hong Kong after the border reopening, and recently we see an even more greater quantity of more Hong Kongers going to the so-called Greater Bay, Shenzhen and the neighboring area in southern China to spend their weekends. So this will create more travel-related spending in mobile services for Hong Kong Telecom. With regard to enterprise services, we expect its enterprise services to remain robust as enterprises in Hong Kong as well as in mainland China accelerate upgrades to their infrastructure and systems. Okay. In terms of broadband businesses, future growth will be spurred by further uptake of fiber connectivity and value-added services such as home Wi-Fi solutions. With regard to its pay TV business, we expect it will continue to deliver a steady performance as the appeal of Now TV's diverse content offering, in particular live sport events, has driven steady growth in customer subscription, particularly in the hospitality sector. Okay. The share price also outperformed the Hang Seng Index and the broad market. We expect it to test the high, the peak seen in February last year, around $10, 15 Hong Kong dollars. So about 6% upside, together with a close to 8% dividend yield. So we are also expecting a double-digit return for HKT Trust. Okay, that ends my presentation here. So we'll move on to the fireside chat.
Oh, yes. Hi, thanks, Louis. Thank you for the great presentation. And we'll now proceed with the fireside chat before we will begin the Q&A session. Right, so just basically want to just discuss some of the interesting topics that might have been happening recently before we engage the direct questions that the audience might have. During this time, the audience can also ask more of the questions that you might have on the Q&A box and upvote your preferred questions so that we can actually target the higher upvoted questions first. Right, so for the first one for Louis, maybe I'll just discuss on, you mentioned about the regulations by the China government on the gaming industry. So for example, Tencent and NetEase were the most impacted during the recent the gaming regulations in the December. So how is the impact going to be like for not only the gaming side, but is the regulation fear still coming into play? For example, for the 2023, I think the impact was mainly on internet property, and then the ending was gaming industry. How will the 2024 outlook go for the fears for regulation risk?
Okay. We think that it will be balanced by some relaxation. You notice that following the announcement of the draft to the article, is called Article 18, that regulate the online games operators. Subsequently, the authority approved more than 100 games just a few days after this draft was being announced. I think they are trying to soothe the market fears that the draft was too stringent. So they increased the number of games approved lately. In 2023, monthly average new games being approved by the authority stood around 80, between 80 to 90, just 80 plus. Okay, so lately the number of new games being approved early this year, early this year was up to more than 100. It's 108, I think, around that. So 20 more than the average number last year. So I think going forward, they may speed up or they may increase the number of new games being approved. On the other hand, they will try to regulate on the spending. Now, I think they are more concerned about, in the past, their concern is teenagers are spending too much time playing online games. So they roll out rules to regulate, to control the time that teenagers can play online games to around 2 hours, only on weekends and during holidays. Okay, now they are concerned about the spending, overspending by players, online game players. So the impact on the publishers, the game publishers, will be their profitability will be undermined. That's quite for sure, because they earn the revenue from the spending, in-game spending, and also the purchase of in-game items to play the games from the players. They earn. This is the revenue model. They earn from these sources. So with the new revised guideline, we do believe that the profitability of companies, with, especially I mentioned just now, with high ARPU games, will be impacted more. The ARPU will come down. So maybe in future, we see more games being approved that may help a bit the operators, and also they may develop more high DAV, daily average active users, low ARPU games. They may develop more low ARPU games to get more users. And they will change the revenue model. In the past, it is high ARPU model. Now it's high DAU and low ARPU model. So they have to make up their loss of revenue by rolling out more games, more low ARPU games.
Right, thank you. For the next one, maybe I was just asked about for China, right? Because they have the slowing economy, and we're talking about both Hong Kong and China in terms of the stock market performance. So how effective can China actually use any physical or monetary policy to actually help to boost the economy for this year? Looking at the impact is that currently they do have both external issues and internal, and meaning external, meaning example, they have more tighter relations between the US and the Western countries. So how effective will their policies be, especially with the interest rate environment currently in the US that is still on a higher side, even though they might be coming down soon?
Yeah, admittedly, we are afraid that the effect will be rather limited, whatever fiscal policy and monetary policies. As I mentioned, on the first hand, the Chinese government refrains from rolling out very aggressive kind of stimulus packages. So that's first thing, that we don't expect any trillions type of 4 trillion stimulus package as they did many years ago in 2008. Okay, even rate cuts. You notice that last year they did 2 rate cuts, each by only 10 basis point, not even up to 1 percentage percentage point, not up to 25 basis point, only 10 basis point. So it's very gradual. Gradual policies will result in gradual improvement in the economy. So the recovery we expect will remain rather slow. Yeah, and there's also some structural problems that need longer time to resolve. For instance, the property developers debt crisis and also the downturn in the property market. We don't expect that can be improved overnight. It may take years to solve the debt problems, and also to take years for us to see a revival in the property market, especially in many third tier and fourth tier cities. There is oversupply of residential property. That would take also years for the market to take up, digest the oversupply. Okay, and the U.S. China tension will also we also expect it to continue. We will not see any sharp turn in the near term. So this will all drag on the macro economy for the time being.
All right. Okay, so just now you also mentioned that currently in the current climate, looking at the current stock market, maybe we can actually look at the utilities as well as the telecommunications as a defensive sector. But because also we see that now Hong Kong is also on a lower side, in Hong Kong and China, the stock market performance is already a lower side compared to the past few years. So let's say we are looking to position ourselves for a longer term, perhaps 2 to 5 years. Do you propose that we look at the more growth sector, like example, the AI team, your EV, your semiconductor, or actually we still should actually look at the defensive like utilities and also the telecommunications for 2024 itself?
Okay. We still advise investors to be more risk averse. So that's why we recommend defensive plays such as utilities and telecommunications, and local Hong Kong companies. They are less exposed to China's economy. So these are double protection. First of all, the industry itself, utility and telecommunications are defensive by nature, more defensive by nature. And secondly, their business is more outside China. For power assets, it does have overseas. I mean, just now I have been, I mean, in my introduction of power assets, there's business in other countries such as UK, Australia, and Europe as well. So it's more diversified in terms of geographical risk. Okay. But for investors, they who are besides that, besides the yield, the dividend yield that start looking more attractive following the U.S. entering a rate cut cycle. Besides that, we think over time, when the economy, when China's economy and the Hong Kong local economy stabilize, there will be a time, and it may take longer. When it stabilizes, then we expect a revaluation in the share price. So investors investing in these companies first, they will earn the dividend return, as well as an expected revaluation, because now, as you mentioned, the valuation is quite cheap. It deserves a revaluation once the economy, once things brighten up, when the economy stabilizes. For We also like environmental protection businesses, maybe in China. Recently, we noticed that some water treatment companies, such as Beijing Water, the ticker is 371.HK, 371, and Everbright Water, they are seeing their share price more increase in turnover, more funds flowing in, and also the share price strengthening. So environment protection industry will tend to be less cyclical, not very much affected by economic cycles. So utilities, telecom operators, as well as environmental companies.
Okay, so before I move to the Q&A, I got one last question. Actually, this actually on the aspect of there's these two teams that usually have been growing for the last few years, is the technology side and the EV. All right, so we now know that recently there's a lot of cross investments. So like the EV companies coming out with their mobile phone, and some mobile phone companies coming out with their own EVs as an ecosystem play. So how do you feel this development will actually come into place, seeing that, let's say, Apple, Xiaomi coming into EV market and EV might trying to go into the mobile space? What is the impact that you actually expect for these two sectors or these two industries itself?
Okay. One thing for sure is China's EV market will become more competitive. The competition will become more intense. Since December last year, you heard almost every day reports that the EV manufacturers are offering different kind of promotion packages, which is actually price cuts to their products. Lately, it's Li Auto. That's why Li Auto share price dropped quite substantially the last few days, because following the report of its price cut of all of its L7, L8, and L9 series. And Tesla is also seen continuing cutting prices because of the competition getting more intense. This competition is aggravated by more new entrants into the EV arena. For instance, you mentioned just now handphone manufacturers such as Huawei, Xiaomi, and Meizu. Now they all have plans to manufacture EVs. Actually, Huawei already had rolled out their EV products, and Xiaomi is expected maybe this year or next year the EV. Okay, the new forces, new EV forces, the so-called Hui Xiaoli in the past now was replaced by another new new forces. I would describe it in such a way. In the past, the new three new forces, EV new forces, are namely Li Auto, NIO, and Xiaopeng. Now they are replaced by Huawei, Xiaomi, and Meizu. Uh, for these telco operators, I think they do have an competitive advantage over the EV manufacturers, the car auto manufacturers, because they have the expertise in handphone, and also now increasingly a EV electric vehicle functions more like a handphone or PC. Huawei and Xiaomi, which have their own operating system OS, will have a more competitive advantage compared to, in the trend of digitalization and automation. They can tap on their OS, handphone OS operating system design expertise to make the cars more powerful in the sense in terms of digitalization and automation, and they can they be less vulnerable to price cuts if the products are becoming too commoditized.
All right, thank you, Louis. So we'd like to move on to the Q&A, which I do see there's quite a lot of upvoted questions already. So do keep your questions coming if you have any, or you can upvote the questions that you are more concerned on. So currently, the first most upvoted question is actually, what is the view on Alibaba, Meituan, and Ping An? These three particularly.
Alibaba, Meituan, and which one?
Ping An.
Ping An. Among the three, we are more downbeat on Meituan and Ping An. Alibaba, we are neutral. We have a neutral rating. First, for Alibaba, is facing more competition from other competitors such as Pinduoduo, not only in China but also in overseas. Tianmu is doing quite very well under Pinduoduo, and then other not e-commerce operators besides JD and Pinduoduo. We also noticed that companies like Kuaishou and those short video operators and Douyin, they are entering the e-commerce arena. And the cloud services, once fast growing growth engine for Alibaba, now is under tremendous competition from Chinese telco operators such as China Mobile, China Telecom, and Unicom. Alibaba used to have more than 50% market share in the cloud service market. Now it has decreased to close to 30%. And also the growth rate, at most you only see single-digit growth in revenue in its cloud business division. And perhaps because of the decline in profitability, Alibaba has announced that it plans to distribute, to spin off the cloud business division and distribute it in the form of physical shares to its shareholders. Yet, because of the market sentiment, this did not materialize last year. And also the other listing plans of, for instance, 菜鸟 and 河马先生 both were called off last year. So there was also report that it is other uh, uh, growth driver, the 支付宝 Alipay, is considering handing it over to the state. So this will all weaken the profitability of and also the growth prospect, growth outlook of Alibaba. This one we are, because it has share price has dropped. I mean, in view of this valuation share price, so this for Alibaba, our rating is neutral. Let me see the share price. Give me a few seconds. Um, Now it's very close to the December low, around $67. So if it drop below the 767.80, that was the low seen in December last year. Today it dropped by more than 2%. Now trading at $68.55, 65 55 $68.55. If it drop below 67.80, we're looking at the next support level around $65, whereas resistance is expected around 70 to 72 Hong Kong dollars. For Meituan, also facing severe competition from 饿了么 and also new entrants to the food delivery the industry, such as Douyin. That's why Meituan is planning to go overseas, and Hong Kong is the first trial market. But it seems Hong Kong is also very saturated already. The delivery, food delivery market. We have Food Panda as well as Deliveroo. Even Uber Eat cannot survive in Hong Kong. So Meituan's Kita, whether it can survive and is remains a question remains to be seen. Okay, the share price it is even weaker than Alibaba, showing new low recently. Let me see today. Three six. Yeah. The recent low was 69.55. So we expect support around $70. And today it was down more than 3% to $73.15. The overall trend is still a downtrend. We expect support around 70 Hong Kong dollars and resistance around 75. Okay. The other one is Ping An. Ping An, because of its investment in certain property developers in China, and also now uh, 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 the low interest rate environment in China also doesn't is not favorable to insurance company. It will become more difficult for them to earn a decent return for its insurance premium. The to It's very close to the 52-week low, $31.50. Now it's trading at 31.85 cents. Today, the low intraday low was 31.70. So we expect it's still on a downtrend. It will test the 30 Hong Kong dollar support in the near term. Whereas if the share price rebounds, we expect resistance around 33 to $35.
Right. Thank you, Luis. The next question we do have is the question by one of the audience is explaining why the financial stocks like the big four banks and Ping An listed on both China and Hong Kong have a greater price difference of around 20 to 30%.
This always happens. This is known as the A share premium because A share market is still closed to foreign investors. Now foreign investors can with the stock connect they can go through the stock connect, but even with the stock connect, investors cannot arbitrate on the two markets. That means for if you want to make profit from the arbitrage, you may buy the X share listed in Hong Kong at a lower price, and then transfer the X shares, convert it into A share in China, and then sell on the A share market to earn to get a higher price. But this is not possible because there's no direct transfer of X shares between Hong Kong and Shanghai and Shenzhen shares. Okay, investors can trade through the stock connect on the individual market and settle on the individual market, but they cannot transfer the shares to another exchange or another and sell on the other market. So the premium reflects that mainland investors have a different, the valuation, mainland investors are willing to give to these companies a much higher than Hong Kong investors, especially international investors demand a much lower valuation for risk reward, so that this A premium is in existence for quite many years, and we don't expect a narrowing in the premium until actual arbitrage becomes available and feasible between the two markets.
All right, thank you. So another one is actually the broker analysts have recommended that investors buy quality high yield stocks to defend the continuing market downtrend. So what is the view on this, and any particular stock you can recommend for high yield investment? So I think just now you mentioned some already for your defensive one. So is there any other counters you might want to look at?
Okay. Coal mining companies such as Shenhua, Yankuang, Yanmei Ziyuan, 1171. Shenhua's ticker on the Hong Kong market is 1088, and Zhongmei Nengyuan 1898. They are also paying, the dividend yield is more than 10%. So coal mining, the coal supply is currently on a balanced situation. There's no oversupply, and sometimes there is also tendency for coal prices to rise. Say, for instance, if China bans import of foreign coal from Australia and Indonesia, when in the last 2 years, when they banned imports from Australia and Indonesia, the domestic companies benefit. Okay, and I think going forward, you may see more cold winters like this year. You may have seen reports about the severe cold weather in the northeastern part of China. So that will also create more demand for coal. So coal companies with dividend yield more than 10%, I think also worth considering. The three companies I mentioned, Senhua 1088, one Yanmei Nengyuan 1171, and Zhongmei Nengyuan 1898. Besides in the oil and gas sector, I think CNOOC also paying more than 10% dividend yield. With we are not particularly upbeat on oil prices. We think oil prices they are both positive factors and negative factors. So it's like rather neutral kind of for WTI. You notice that the price always fluctuate between $65 and 75 because there are both positive factors, and as well positive factors is the OPEC plus they are uh, cutting their coal output, but on the other hand, negative factors will be more on the demand side, with China's recovery still not strong enough. So demand for oil and gas will be for crude oil will be affected. And also US, whether there is a slowdown or a mild recession, will also affect demand from the US, which is the largest consumer of crude oil in the world. But since they are both positive and negative factors, we think oil prices would be rather stable. It will fluctuate between a tight range. It will be rather stable. And so CNOOC, which is more on the upstream, its business more on the upstream business will benefit from relatively stable oil prices, and its dividend yield looks attractive. So 883 CNOOC is also one recommendation for investors who are looking for high yield stocks.
Okay, so next we also have a question on regarding how does power assets compare with the CK infrastructure?
I never like tower assets, 中国铁塔, right? Are you referring to China Tower? Is it?
No,
Or power assets
power assets versus the
compared to what? Sorry, compared
CK
to
infrastructure.
CK Infra. CK
Yes, CK.
Infra is actually the shareholding relations is CKI holds power assets, and power assets holds this Hong Kong Electric. But if you look at the dividend yield, just compare the dividend yield, now power assets dividend yield is likely higher than CK infrastructure. So if we chooses among the two between the two companies based on which one is paying yielding higher, it should be still power assets. And CKI is also a good company. Since listing, is every year it increased despite economic upturn or downturn. Every year it increased its dividend payout. So CKI is also good.
Right. So next we also have questions on SMIC and China Mobile.
Okay. SMIC 981, the policy risk or the it always falls victim to US and China tension. Uh, so if you look at the share price, it's also on a consistent downtrend. If it's not able to acquire the equipment for manufacturing more advanced chips, namely 7 or 5 or even down to 2, 3 nano meter chips, then it may over the long run it may lose out. At the moment, it's still there's still demand for its mass market product. For instance, the 45 nanometer and 28 nanometer. There's still great demand for those products, and especially TM Taiwan Semiconductor, TSMC, and Samsung are no longer producing those relatively low end 45 and 28 nanometer chips. So it gives the room to SMIC. But going forward, these products maybe uh, become obsoleted, and the demand will decrease. Then it will be a problem for the company in the long term. Okay, China Mobile, the yield is attractive, and also the business nature is also quite defensive. We also like China Mobile, and among the three telco operators, its competitive advantage is the greater compared to China Telecom and China Unicom. Now it's yielding 6.6% dividend yield. So yes, it's also one stock other than Hong Kong. If you want one that has exposure mainly to China, then China Mobile is also worth considering.
Okay, thank you. So there's one question on this. What is three most important takeaway that you might want to give the audience for Hong Kong and China for this year?
Okay. First of all, the headwinds we are facing, there are still a lot of headwinds. You can go through my slides. What are the headwinds that the Hong Kong and China are facing? So the other takeaway is we don't think there are quick fixes to China's economic problem. It will take time for the debt crisis and also U.S. and China relationship to improve. So our last recommendation is go for the investors to advise investors to be more risk averse and go for the defensive plays such as utilities and telcos.
Okay. So we also have another question is just a more generic one is should we still invest in China for 2024 or should we scale back on the investment?
Before there are evidences that the economic growth, economic recovery picks up, we still recommend lower allocation to China, albeit some investment houses now view that China is uninvestable. I think that's quite extreme now. We won't say China is uninvestable. Yet we still recommend a smaller portion, lower allocation of your assets to China for the time being.
Okay. So next one we have is what is the outlook for the green energy industry? I think just now you mentioned slightly. And companies like CATL and BYD have dropped significantly in the last few months. So is there a silver lining in this green energy sector?
Yeah, we noticed that the installation capacity installation for solar photovoltaic will grow faster than wind power. So solar power, we are more upbeat on solar power. Uh, there is one we favor the solar glasses manufacturer, this 6865 flat glass, because it's the market leader. And now solar glasses, at one time it faced oversupply. Now it's more or less supply and demand is more balanced, and with the decline in silicon prices, the cost for setting up solar farms now has come down. So we do expect more demand for solar glasses. And this flat glass, a company called Flat Glass 6865, will stand to benefit from the the installation will not only come from China but also from Europe and the US. Europe 2024 install capacity is expected to grow by 16%. And US is expected to grow by 33% photovoltaic install capacity.
Okay. Now currently we have one is what is the latest assessment on the JD.com?
Oh, we think it's even in a worse situation compared to uh, Alibaba. As I mentioned earlier, the e-commerce industry in China is under tremendous competition. And then Alibaba, it's more diversified in a sense. It has other new businesses, but for JD.com, is less diversified compared to Alibaba. It's more reliant on e-commerce. Okay, and now it's also facing uncertainty with its strategic business transformation. In the past, it operates more like a third-party platform for a platform for third-party uh, third party brands. But now going forward, it is adopting a business strategy of direct operation. So it will source its own merchandise that will bring higher profit margin to the company. But whether this transformation, this business strategy transformation will bear fruit is not certain yet, remains to be seen.
Okay. So actually I looked through the Q&A. There's one that is actually that we haven't touched much today. Is what is the view on Yum and also Mengniu, which are the consumer counters for Hong Kong and China?
The view on what? Sorry?
Yum China and Mengniu.
Oh, Yum China.
Yeah.
I like Yum because it has a very stable expansion plan. Now its restaurants in China has grown to more than 10,000, and it has a medium term target of opening up to 20,000 outlets, restaurants in China. And even during the COVID periods of from 2019 to 2023, Yum Brand China, we saw that Yum Brand China is still opening more restaurants in China. When is by no means affected by the COVID pandemic. But its share price weakened recently is because there was a drop in its gross profit margin. Okay, so until there are evidence that shows an improvement that is gross profit margin improves, its share price will still be under selling pressure until the gross profit margin picks up. Okay.
Okay. So in this continuing this chain of question, there's one more. Like instead of the China ones, they're looking at what about defensive Hong Kong-based consumer stock, which is like Vita Soy and Nissin.
Mm. Vitasoy is very the price is quite pricey, and now it's no longer a Hong Kong play because in the first 6 months ended September 30, 2023. I just went through its interim results. 57% of its revenue came from China. It has expanded into China. So for a time, a lot of institutional investors like Vitasoy because of its expansion plan, a bigger market, much bigger market in China. But now China, the growth has stalled, so it becomes a instead of being an asset to the company, it becomes a liability, a burden, and then the yield is very low, 1% yield, 30 times PE. Not really worth looking at the current valuation and the dividend yield, and also the business outlook as 50%, more than 50% of its revenue comes from China, mainland China. It has tried in the past. It has tried to expand into Australia and New Zealand and Singapore. You can buy Vitasoy products in Singapore as well. But both markets in the last 6 months in the financial first half in up to end of September 2023, Australia and New Zealand and Singapore all recorded operating losses. So they don't make profits in other overseas market.
Okay, so because of time itself, we're looking at the last two or three questions. So first one, the one we what do you recommend some of the investors that currently hold existing EV companies, Hong Kong counters like Li Auto and Expert? Do you recommend them to actually hold, or maybe is there any like bearish view on these counters?
Yeah, Li Auto has announced their 2024 sales target, 800,000 vehicles units. So that implies every month it has to sell at least 65,000, which may be challenging at this kind of market environment, and especially if they want like last year, close to the end of 2023, we saw that more than 20 EV brands in China cut prices because they wish they are under pressure to meet their annual sales target. So with 800,000 sales target for 2024, I think it first of all the target is quite challenging, and secondly, if it fails to meet it, it will add more pressure on the company to cut prices to in order to meet the sales target. So I think BYD is a safer bet lah, and is less aggressive in setting its sales target after reaching more than 2 million units last year. And BYD is more diversified geographically. So I think you may switch lah, do a switching, sell Li Auto and buy BYD. Although BYD share price, we do expect it may not hold above $200. And if it breaches the support of 200 Hong Kong dollars, downside next target maybe it may go as low as 180. So be careful lah, watch out lah.
Right. So maybe we can have our last question is what are some of the business and regulatory risks that will be facing your two stock counters recommendation just now for Power Asset and HKT? Are there any business or regulation type of risk that they are facing?
Okay. Power assets, as I mentioned, its business portfolio is very diversified, mainly in the UK, Australia. Those are developed economies. So it's a regulated business. yet it's predictable. It will not be like some emerging countries or in China. Sometimes the regulations and policy initiatives are quite unpredictable. So I think the visibility is higher for both companies. And Hong Kong Tea it mainly operates in Hong Kong. I think not much policy risk is less a lesser concern. Factors that may impact its business will be the its roaming business will depend very much on cross-border travel and also demand for new handphones, those more related to consumption.
All right. Okay, so we're at 1:55 right now. All right, I'd like to thank Louis again for the presentation and the interactive Q&A that we have. So we have now come to the end of the webinar for today, and we'd like to thank everyone for joining us on this Tuesday afternoon. Right. For this session just now, we will be uploading the recording on the Philly Capital Facebook page and YouTube. You may actually view the recording on your own timing. Right. So we also have many other interesting webinars going on almost every other day. So you may view our full list of free webinars on our website as well. So do also take your time to fill in the survey that we have to improve your experience that you have with us for today for the future. So you may scan the QR code or copy the survey link in the chat tab for this survey itself. Right. So we also have interesting communities, all right, in our Poems 3.0 app. So you can get full access to our research reports and discussion on technical analysis, among other topics. Right. So you can just download the P3 Poems 3.0 app, and then you can actually access this community itself. Okay, so once again, thank you all for joining us, and we hope to see you tomorrow. For tomorrow, we will have our speakers from Thailand market to discuss topics including the interest rate upcycle, its impact on SET, listed firms, government support in Thailand, and the influence of global economies on Thailand economy itself. So stay tuned, take care, and have a nice day ahead.